Asian stocks swings and gains and losses. Some say that it's taking its cue from China, from the yuan, but not today.
So I think it's important to highlight the overall global economic growth outlook and what that means for markets. Here in Asia, we had very strong markets, particularly in China last year, as it really led the global recovery. That leadership, however, is very clearly passed to the U.S. What we're now dealing with in many Asian markets is a resurgence of COVID cases, and that impacts the overall economic outlook in two ways. Number one, you are seeing relatively weak domestic demand, particularly on the consumer side, in multiple markets around Asia, and we saw that in the China numbers last week and the prior week. It also is impacting manufacturing, however. As plants shut down, reopen, shut down, we are seeing the longest lead times in manufacturing in over 2 decades, which does matter. So even if you have strength in the manufacturing sector, that only represents about 1/4 of the overall economy for most Asian countries. And so it is a significant drag until we can get the retail and consumer demand back up and running.
James, is it also about good news being bad news? We've heard from the likes of RBNZ, from the BOK. They're pretty hawkish when it comes to the recovery process, leading some to speculate that rates are rising soon, and that's not necessarily good news for the stock market.
It will absolutely be a critical conversation for all of us over the course of the next 12 to 18 months. JPMorgan House view is that you will see a spike, particularly in core inflation, as we move through the rest of this year. JPMorgan numbers has core inflation going to 2.8%, which would be the highest print since 1995. However, the backdrop to that is incredibly important. We're coming out of a 2-decade period of deflationary trends where we were all debating the dangers of deflation. Now that we're simply moving back to a more normalized inflation environment, there's a degree of overreaction in portions of the conversation, at least in my view. We don't see significant tapering in any major market globally until deep into 2022, with the sole exception of the Bank of England in the UK. We are looking at central banks basically taking a wait-and-see approach that's consistent with what we've heard out of the Fed. It's consistent with what we heard out of central banks around the IMF, World Bank spring meetings in Washington, D.C., where the real focus is waiting on the data and not focusing on the forecast. And so we don't see a real danger of central banks being too fast. If anything, it's likely the opposite.
James, also looking at what's going on with the markets and where they've been going, and many people are talking about them looking very rich and fully priced, as it were, but you're suggesting don't look at the valuations, focus on what? Should you be looking at the P or the E, or neither?
So it's ultimately both, but I think we can't just focus on the multiple without focusing on the directionality of earnings. One of the things that we've seen in global markets for a long time now, valuations matter only after a catalyst. And if earnings revisions continue to be as positive as they've been, in the United States, you've seen 45% of companies beating already increased expectations. In the EU, similar types of numbers. The very, very positive earnings revisions cycle that we're seeing in most global markets now does not provide that negative catalyst. The two things that we're most focused on for a potential market correction, number one, would be significant changes in liquidity. Now, we did see a peak of liquidity in the first quarter of 2021, but we don't see a significant drawdown throughout the rest of this year. The second thing that we'd be focused on, and this obviously links to the earnings conversation, is a change in the business cycle. And there, we are looking for a slow reduction in PMIs as we move through the second half of this year. However, it's a reduction from elevated levels, and we still see PMIs sitting above 51, which is a very positive market for equity as an asset class.
James, we've also got, of course, a further ramping up of tensions between the U.S. and China, not least with Kurt Campbell, the coordinator for Indo-Pacific Affairs, talking about the period that has gone before us as being described as engagement, and saying that engagement has come to an end very quickly. Are you concerned about the geopolitical headwinds of this and other points of contention?
I think we have to be concerned, and we've written a lot about it at JPMorgan. Ultimately, you're looking at a significant shift in the ordering of how countries interact with each other. And that's not going to be quick, and it's not going to be easy. What we're still very focused on, however, is the fact that there are still significant areas of cooperation. If we think on topics like climate change, if we think on topics like financial inclusion, then there are still very clear areas of cooperation between multiple countries around the world. We still think that that cooperation will proceed because it is in the national interests of countries to do that. And so we don't think it will be a purely competitive structure moving forward, but it's very clearly an area that we need to monitor.